look at problem 814. We talked about budgets. We said the budget is the target. So for example, we're going to have a certain target for sales. That's the sales volume that we want to achieve. But importantly, one of the things that we need to look at carefully is when there's a variance from the amount that we budgeted. So we budgeted a certain amount for sales, and this is to be expected because we don't have a crystal ball. We just have a goal for what we want sales to be. But as managers and as part of managerial accounting, what we need to do is identify when we don't achieve our budget. So when we don't achieve our target, when we don't achieve our goal. So we need to do some analysis. And there's different types of variances that we could have. And that's what we're going to look at now. So in this problem, we have Jake's roof repair company has these expenses. They have some fixed costs for the month, and then we're also given as part of this problem the cost per repair hour. So we know that wages and salaries should be $23,200 plus $16.30 per repair hour. Now the company expected to work 2,800 repair hours in May, but actually worked 2,900 repair hours. So we actually worked more hours than what we had originally budgeted for. The company expects its sales to be $44.50 per repair hour. So what we need to do is to prepare a report that shows the company's activity variances for the month of May. So everybody follows what's going on in this situation? So if we actually work more hours than we anticipated, how is that going to impact our costs? What's going to change? So the direct labor, which is a variable expense, so that's going to change. So we want to understand where there's going to be a cost variance. The fixed costs, we said, are fixed. So those are not going to change. But we anticipated that the number of hours would be 2,800, but actually we worked more hours than what we had anticipated. So let's see how this is going to turn out in terms of ultimately our net operating income. Are we going to have a favorable variance for net operating income or an unfavorable variance? And we're going to look at the revenue. So we want to understand if we have a favorable variance in terms of revenue or unfavorable. And then look at each one of the expenses that were given in this problem set. So we know wages and salaries, parts and supplies, equipment depreciation, truck operating expenses, rent, they tell us is $3,480. So before we'll jump ahead just quickly to this one point, are we going to have a variance there? Is it going to be favorable or unfavorable? What do you think for rent? What does your gut instinct tell you about rent? Do you think it's going to be unfavorable? Why?
Same.
It's going to be the same, right? There's not going to be any variance there because rent is a fixed expense. We know that fixed costs are fixed, right? So there, rent is not going to change. But there's going to be some other expenses that are variable expenses. Those are going to change, and we need to find out whether or not those variances are favorable or unfavorable. So we need to get accustomed to and comfortable with dealing with variances. Because as good managers, we need to have a plan. Hope is not a plan. So we need to have a plan. We need to anticipate what our sales are going to be in terms of dollars and also in terms of units for a particular group of products. How many units we're going to sell 6 months to a year before. So that being the case, there's always going to be some adjustment that we're going to have to make, unless we just happen to guess correctly. But almost always there's going to be some variance, and we need to make an adjustment for that. So let's take a look at the activity variances for Jake's company. All right, let's start out. Let's first make a note for ourselves. We'll start with repair hours, but first we're going to put down what we planned. The flexible budget. And then the activity variance. You remember last time we made an important point about flexible budgets and static budgets. What did we find out last time as it relates to budgets when we started to initially talk about variances, and when we said, well, that's a little misleading to say that there was a variance? Remember when we talked about the deli? Right? The guy who had the
Wolf Deli.
Right. Wolf's Deli, right? And we said, well, wait a minute, is that really a variance? Like, is that really, are we comparing apples to apples, or is it apples to oranges? Or is it pastrami to corned beef comparison? Does that ring a bell to anybody? Mm-hmm. Yeah, just say yes. Just go with that, right? What was the issue there in terms of what we initially said was a variance? Go ahead, Greg.
You said that, first you said that actual sales were less than the budgeted sales, so that's a favorable variance on food costs. Since it was less sales, that means less food costs, so it's a favorable variance.
Right, so we said that's a little misleading because, of course, if we're making less sandwiches, then we're using less bread. So what we need to do is make a comparison in terms of the cost that we actually paid for the roast beef. So you see what I'm saying? Of course, if it's a variable expense, the fewer sandwiches that we make, the less bread that we're going to use, the less roast beef that we're going to use, the less mustard that we're going to use. That's different from saying that we were able to buy roast beef now at 20% less than we were last month. So that would be a favorable cost variance. So the price actually went down. But in the situation that we were talking about last time, the price didn't go down. It was a variable expense, so we used less. So the price of roast beef didn't go down. It's just that we made fewer sandwiches, so we used less roast beef. So what we're going to talk about now is, with a flexible budget, how we could come to a apples-to-apples comparison to adjust for that. All right, so let's see what we know. Repair hours. So we were anticipating we had budgeted for 2,800 hours. But what happened? We actually had 2,900 repair hours, and this is the impact that it had on revenue. So we're going to look at revenue, we're going to look at the expenses, and then ultimately we want to see what impact it had on net operating income because of this increase in the number of repair hours. So revenue, we need to calculate. How do we calculate the revenue in this situation? $44.50 per hour. So it's $44.50 per hour. And in this case, it's going to come to what? $44.50 times 2,800 is how much? Right, 124,600. And now we have 100 more repair hours. So it's how much? $129,050. So they didn't tell us what the total sales were. What they told us in this situation is how much we got paid per repair hour and the number of repair hours. The number of repair hours that we budgeted for and the actual number of repair hours. So we have to calculate that. So that's 2,800 hours times $44.50 per hour, and then the actual turned out to be 2,900 repair hours, and we multiply that by $44.50. Everybody follow? All right, so then let's look at the expenses. Wages and salaries. All right, so what are the wages going to be?
1,630 times 2,800 plus 23,200.
Right. Everybody see why that is? So the wages are what?
68,840.
Right. So we have those that are the managers or supervisors that are getting a fixed salary. In this case, it's $23,200 per month, and then we also have to pay $16.30 per hour. So we bill at $44.50, and we pay the workers $16.30 per hour. So we have to calculate that. So at 2,800 hours, how much does that turn out to be?
68,840.
Right. So this is the 23,200 plus 2,800 hours times 1630. That's the 68,840 that we had budgeted for. Then, what did it actually turn out to be?
2,900 hours.
2,900 hours, which gives us $70,470 for wages and salaries, which is the 23,200 plus, right, that's the fixed part of the wages and salaries, plus 2,900 hours times the 1630. 1630, right?
Yeah.
So that gives us 70,470. All right, so before we go any further, let's look at the revenue and see if we have a variance and if it's favorable or unfavorable. How much is the variance? This is what we had budgeted for, 124,600, And this is the actual, $129,050 for our revenue that month. Not too bad for 1 month's revenue.
So the variance is just the difference between the two?
Right.
So it's 1630.
1630. So we subtract from the 129.50 the 124,000.
Forget about that. I was doing the wages.
Oh, okay. So how much does this turn out to be? 44.50. Now, is that variance favorable or unfavorable? Favorable. So we'll just put F. So we were budgeted for 124.6. Turns out we had a favorable variance. Our revenue is actually more than what we had budgeted for. So that's 44.50. Now let's look at the wages and salaries. So now remember, this is a cost. So let's look at the cost. All right, so we're going to go through all the costs, but let's start with wages and salaries. We had budgeted for $68,840, but actual was $70,470. What's the difference?
1630. That's where I got the 1630 before.
There you go. You had the right answer, but to a different question.
There you go.
Right?
Exactly.
And so is that favorable or unfavorable?
Unfavorable.
All right, so who could explain to us why that's unfavorable? What happened? Krista?
Because if you allotted how much? The 68,840 for wages, and then you go over, you have to take the additional money from something else and you get the budget for that.
Absolutely. So we had expected that wages and salaries was going to be $1,630 less. So if we go over our budget in terms of sales, in terms of revenue, that's a favorable variance. We're never going to turn that down, right? But that's not going to be viewed generally as negative. But when our expenses are higher than what we expected, we consider that to be unfavorable. That's undesirable. Questions? So that's unfavorable. What about parts and supplies?
8.6 times 2,800.
Right. So we're told that for parts and supplies, the cost per repair hour is $8.60 per hour. So how much does that come out to be, Greg?
$24,080.
Right, $24,080.
You're gonna give a lot of these questions on the exam, right?
But by then you'll be expert, right?
Oh, that's good, well.
Sounds like you're already an expert.
It's easy. Everything else is.
Doing it the first time is the most time consuming.
This is very easy.
Right? The second time takes you half as long. By the third time, you're doing like in 5 minutes. All right. Then what about actual? How much does this turn out to be?
24,940. 40.
What is that parts and supplies?
24,940, which is 2,900 hours times $8.60, which is what they tell us. And then we have a variance or no?
8.6.
How much is the variance? 860? Is that favorable or unfavorable?
Unfavorable.
Abigail?
I mean, this might sound like a stupid question, but because I left it blank because the fixed cost per month, they didn't have any numbers, so I left it blank. So you're saying still multiply the 8.6 for fixed costs?
Well, what they're telling us here for parts and supplies, they're telling us that this expense for them is variable.
Oh.
That there isn't any fixed component. What do we call a course that has, we talked about this in chapter 5, mixed, right? So we're our responsibility is to classify costs. Classify the cost and identify cost behavior. But as we see here, sometimes in terms of cost behavior, you're going to have some costs that are both fixed and variable. And this is a good example of where that would be the case. But we still need to know the difference, when that would be the case and when that would not be the case. So for wages and salaries, the reason why we have some of the costs that are fixed are because those people are getting a flat salary. They're not working per hour. We pay them a certain amount per week, per month, per year. Let's say they get paid $35,000 per year. $35,000 per year, regardless of how many repair hours. So whether we have 40,000 repair hours in the year, or 60,000 repair hours in the year, or 6,000 repair hours in the year, they still get paid the same salary. Now for us, one of the concerns about fixed costs and why it deserves a lot of attention is that whether we have any sales or not, we still have to cover those fixed costs. So it's not enough to say, we shouldn't be too excited when we say, oh, well, fortunately, we weren't producing any phones or any desks that month. So look at all those variable costs that we avoided, right? But we still have to pay Mary, right? Mary's the plant manager. I don't care if you make 1 unit or 1 million units. I still got to get my salary. So that's why fixed costs are of concern to us, and that's what puts the stranglehold, if you will, on so many manufacturing companies. Because when their sales start to decline, because of, for example, like a recession, like we're experiencing now, they still have those fixed costs. So when they were selling 50,000 units per month, they were able to spread those fixed costs across 50,000 units. But then if there's a significant decline in demand because of the recession, and they're only selling now 10,000 units per month, then you can see why there's a problem. Because now instead of 50,000 units, they're only selling 10,000 units. And those 10,000 units have got to absorb the fixed cost. That's known as fixed cost absorption. And so the more units that we sell, the smaller the amount each unit is going to have to absorb. So the more units that we make, ultimately the more profitable, in theory, the company is going to be. Because the cost per unit is going to decline. So for parts and supplies, that's a variable expense. And then we have equipment depreciation, which is what? We said there's a certain, in this case, this is another example of a mixed cost. Because equipment depreciation, we have the fixed cost per month is $1,600, and the variable cost is 40 cents per unit. So in this case, it's going to be, we had budgeted, how much, $27.20?
Yeah.
And then actual,
$27.60.
$27.60. So we have a variance of $40, which is unfavorable. We have truck operating expenses. Which is also in this case a mixed cost. $6,400 is the fixed cost per month, and $1.70 per repair hour. So we had budgeted 11,160, and actual was 11,330. And that gives us an unfavorable variance of $170. Questions so far? All right. Rent. Rent, we said, is not going to change, even though we had 100 more repair hours than what we had budgeted for. We had budgeted for $34.80, and that's actually what the rent turned out to be.
So that's also considered unfavorable?
No.
So what would it be, just like there's no variance at all?
Yeah, there's no variance. Administrative. Administrative expenses, but is also a mixed cost. And in this case, it comes out to $6,740 is what we had budgeted for. And $6,820 was the actual, which gives us $80 unfavorable. Now we have our total expenses. Let's look at our total expenses. Total expenses, we had budgeted $117,020, and actual was $119,800. Which gives us a variance of $2,780, which is unfavorable. Our revenue, we said, was $124,600. That we had budgeted for. Actual is $129,50. You guys following? Why would we be concerned about that? Why would we be concerned by this variance? So this is our expenses. Our variance for this month is $2,780, which is unfavorable. That means that we had budgeted for a smaller amount than we actually incurred. Why is that an issue? Think about the cash budget that we had put together. What's going to happen here? Because this is an actual business. This is not theoretical. We have this business, we're repairing roofs, but we had, our expenses exceeded what we had budgeted for. What's going to be the problem?
Have a low cash flow?
We may not have enough cash. So this is the information that we use to prepare our cash budget. This is the plan. And you saw last time how meticulous we were and how careful we were about trying to calculate actually how much cash we would have on hand, what our cash disbursements would be, how much we would have to borrow, and then after doing all of that, we find out that, our expenses were actually almost $3,000 more for the month than what we had anticipated. So what would you do? What would you do? It's Greg. all of a sudden you find out that your expenses were $3,000 more than what you had expected.
Well, there's a whole bunch of things you can do.
Right, you might have to borrow money from your professor. This, who knows? I mean, that's the first class. So you probably would start there, right?
Hire a few people, borrow money, cut costs, you know, any way possible.
So this is a very big concern for us. In this case, it's about $3,000. $3,000, I mean, either you have the money or you don't. So even if it was $300, or if it was even $30, if you wrote that check and the $30 wasn't there, then the check is going to bounce.
But it's still a favorable, in terms of 1670, it's still favorable because you're getting 1670 more in terms of income.
All right, so now let's look at net operating income. So we know that our expenses were more than what we had anticipated, but so is our revenue, because we worked 100 extra hours that we didn't initially budget for. So our net operating income, as a result, is actually still favorable, $1,670. Does that make sense? That even with an unfavorable cost variance, that's what that is, we have a cost variance of about $3,000, which is unfavorable, our revenues were about $4,500 more than what we had budgeted for. Questions? Okay.
So the revenue increased, but the profit margin shrunk, basically.
The profit margin shrunk. Tell us about that.
Well, if you're paying more money, if you're paying a lot more money to only get 16, if you're paying $3,000 difference, right, extra a month, and you're only getting a little bit more than half that in return profit. So you might be gaining profit $1,670 a month, but through the change in costs, you know, you're spending a lot more money, so it might not be as worth it.
So why is that? Why does that turn out to be the case? Remember, think back also with the coffee example. The reason why is because, and especially in this example, we see that several of the expenses were mixed, where there was variable and fixed. And that's the challenge with fixed. Like we were just saying, is that whether you make 1 unit or 1,000,000 units, your fixed costs are the same. So in this case, we're not going to see, what Greg is saying, we're not seeing a dollar for dollar increase in relation to the $4,450 increase in revenue as compared to the change in net operating income. Because we have to cover our expenses, whether they're variable or fixed. So incremental 100 hours is going to have, and we could calculate what the contribution margin ratio is going to be, but it's not going to have as much of an impact as you might anticipate because we still have those fixed costs that we have to cover. Let's look at the second problem that we had, which was 9.2. helmets now. All right, who wants to read the problem about helmets? All right, so in this case what we're going to do is we're going to look at the direct material variance. All right, so we have this company. And the company manufactures sporting equipment. All right, this company, Kevin's company, Kevin's Sporting Equipment Company, is one of the company's products that we're going to look at that is used in football. So it's actually a football helmet that it sells in the North American market. And Alex, I know, is very excited because this product requires plastic. And so that means that another boondoggle trip for Alex to Turkey to negotiate plastic. During the quarter ending June 30th, the company manufactured 35,000 helmets. It's a nice business to have. And they used 22,500 kilograms of plastic. So the more helmets that we make, the more plastic that we're going to use. The plastic cost to the company is $171,000. And according to the standard course card, each helmet should require 0.6 kilograms of plastic per helmet. Which is a cost of 8 per kilogram. So we know what the standard is. We're going to have a certain standard cost, which is basically what we believe the cost will actually be, and then the actual cost. So what we need to figure out here is what cost for plastic should have been incurred to make 35,000 helmets. So we want to see, is there a direct material variance here? What we had budgeted the cost for the plastic to be and what it actually is. And sometimes it's not only the cost per kilogram or per ounce or per pound that we have to address, but the quantity that's used. Because remember early on in the semester I had suggested that sometimes you might be able to get direct materials at a lower price, but then you might have to use a greater quantity of the direct materials. Because maybe it's still not fully processed. And so in order for us to use it, it needs to undergo additional processing. Or maybe we need to use a greater quantity because there's going to be some waste with that particular grade of material. So that's what we're going to look at now, is whether or not there's a direct material variance, whether it's because of the quantity that was used or because of the price that we paid. So let's see how Kevin's business is doing here. So the first thing we're going to do is we're going to figure out how many kilograms we had estimated we were going to use, which in this case it's 0.6 kilograms of plastic per helmet. And we're going to figure out the standard cost. And then we're going to look at what the actual cost was, what the actual cost that we incurred turned out to be, and determine whether or not there's a favorable or unfavorable materials variance. So we want to determine whether or not it's a price variance or a quantity variance. Who could explain the difference? What's the difference between price variance and quantity variance? So that's basically what I was just describing. Is the price variance means that we pay either more or less than what we had budgeted for. Then there's going to be a price variance. Then we need to determine whether it's going to be favorable or unfavorable. But there could be a quantity variance. So we may have used either less or more plastic, who is it, than what we had anticipated. So we need to identify both, whether or not there's a price variance and if there's a corresponding quantity variance, and then what the total variance turns out to be. But the first thing that we're going to do is we're going to calculate the standard cost. So let's see how we do that. All right. So we're very fortunate that Kevin is entrepreneurial. Right, Kevin? Aren't you excited? Now you have this helmet business. So we know that the number of helmets is 35,000. 35,000 helmets. So remember, what we're trying to figure out is the standard cost here. How much plastic we're going to use, and then how much is it going to cost us. So we have 35,000 helmets that we're going to produce, and we're told that the standard quantity of plastic per helmet is 0.6 kilograms. So what we expect is that to produce one helmet, we're going to use 0.6 kilograms. To make 35,000 helmets, how many kilograms are we going to use?
21,000.
Right, 21,000. So 21,000 kilograms to make 35,000 helmets. Then we need to look at the cost. So the standard cost was what? Per kilogram?
8 RM.
8. So the total standard cost is going to be what? Elena?
168,000.
Right, 168,000. So the standard cost to make 35,000 helmets is 168,000. Questions? Everybody see how we got that? 0.6 kilograms per helmet, 35 helmets, means we're going to use 21,000 kilograms of plastic. And each kilogram of plastic is going to cost us 8 RM. So the total standard cost for 35,000 helmets is 168,000. So then we want to determine what the variance is going to be. So this is what we have to do. The actual, then we're going to look at the actual. So what do they tell us the actual cost is?
171,000.
So the actual cost incurred is $171,000. The standard cost is what we just calculated, is $168,000. So the total material variance is how much? $3,000. And is that favorable or unfavorable? So that means that the actual cost was $3,000 more than the standard cost. Now at this point, just at this very point, we don't know if that's because we paid more per kilogram per helmet or because we used more plastic. All we know is the total. That's what we're given in this scenario, is that our cost to make the 35,000 helmets was $171,000. But for us to be effective managers, we need to probe a bit further. We need to know if that unfavorable variance means that we got a price increase on what we pay for plastic, or we're using more plastic than what we had anticipated. So we need to find out whether it's the amount of plastic or the price of plastic. And that's what we're going to look at now. So we have to look at the actual quantity and the actual price and make a comparison. So that's the second part of that question, is to look at the materials price variance and the materials quantity variance. All right, you ready? Everybody's got this? Are we still in frame? Can we move over here?
Am I supposed to do it?
Yeah, we're going to go over here. All right. So the next part is, this is how we're going to calculate this. Actual quantity times actual price. Then actual quantity times the standard price. And then the standard quantity times the standard price. So we're going to make a comparison here between what we thought was the standard quantity, which is what? Here we calculated it to be per helmet to be 0.6 kilograms, or 21,000 kilograms total. That was the standard quantity. And compare that with the actual quantity, both at the standard price. So therefore, we're going to be able to make a comparison. So this is how we're going to determine what the price variance is, if there is one, and what the quantity variance is, if there is one. So we already know the actual cost incurred, which is the actual quantity times the actual price. That's $171,000. But now we want to determine how that compares to the standard price and the standard quantity. So what we have to do is take the actual quantity, which they tell us is 22,500 kilograms. And we're going to multiply that by the standard price, which is 8. And that gives that gives us 180,000.
How'd you get the first one? 171.
That's what they tell us. They tell us, that's this here. They tell us that the actual cost was 171,000 RM.
What about the actual quantity for that?
The actual quantity,
Doesn't it say
they tell us, is in the third line there. It says using 22,500 kilograms of plastic. So it says during the quarter ending June 30th, the company manufactured the 35,000 helmets and they used 22,500 kilograms of plastic. So that's given to us. That's where we get this from. So this is given to us, this is given to us. That's the standard price, is 8 RM per kilogram. So we multiply the 8 RM times the actual quantity. But now we're going to see where the variance is, right? The variance now is going to be revealed because our standard quantity, which is this, remember we said that we're going to use 0.6 kilograms of plastic per helmet, and that's going to be 21,000 kilograms for 35,000 helmets. So for 35,000 helmets, the standard quantity is 21,000 kilograms of plastic. And the standard price is 8 RM. So this is 168,000 RM. Everybody see what's going on? So what we're trying to do is determine the price variance, if there is one, or the quantity variance. So did we use more plastic or less plastic than we expected? Or did we pay more or did we pay less per kilogram of plastic than what we expected? And we're looking at this based on 35,000 helmets. So a production volume of 35,000. So this we're given. In this case, we're told that the actual quantity times the actual price was 171,000 RM. This we have to calculate. The actual quantity is 22,500 kilograms, which is more than what we had expected. We had expected that we were only going to use 21,000 kilograms of plastic. So let's see what the price variance is going to be and what the quantity variance is going to be. Actual quantity times actual price, actual quantity times the standard price. So there's actually a price variance and a quantity variance. So the variance here between these two, between the actual quantity and actual price, and actual quantity and standard price, is what? 9,000. And that's favorable or unfavorable? Favorable. It's favorable. Why? What happened? Who could explain what happened here?
We're paying less than the standard price.
Right, tell us, Damon.
The actual price is less than your standard price because I guess you're using less plastic or using more plastic.
Right, so you see now where we're making that apples to apples comparison. So if it was just the actual quantity Right, in this case, we're using the actual quantity, not the standard quantity, to calculate this variance. So in this case, it turns out that the actual cost was 171,000, but if we look at what our standard price was and multiply that by the actual quantity, then we know that we have a favorable variance of 9,000. That means budgeted would have been 180,000. That's the price variance. But we also have a quantity variance, which is the difference between these two calculations, which is 12,000. And is that favorable or unfavorable?
Unfavorable.
All right, so does that tell us why it's unfavorable?
Because you kept the standard price constant, and then you compared actual quantity times standard quantity, and actual quantity was more. Giving you the difference.
So that means basically what? That we paid more or less than what we had expected?
More.
Okay, some people said more, some people said less. So it's got to be, we got a 50-50 shot here.
The price is constant. We used more materials than expected.
So the quantity of plastic, this is the quantity variance. So everybody follow what Zev says? We used more plastic than what we had budgeted for. For 35,000 helmets, we expected to use 21,000 kilograms of plastic. That's what the standard quantity is. But actually, we used more than that. We used 22,500 kilograms. Questions? Does everybody follow? You see why that's helpful? Who could explain to us why this is so helpful for us? Because we need to understand what's going on in the organization. So what does this tell us? What does this tell us about the operations of this helmet manufacturer?
It's inefficient because you're using more plastic than you should be per helmet. So they have to figure out a way to streamline.
Absolutely. So we're using more plastic than what we were budgeted for. We need to find out why that is. Why are we using more plastic? And what else?
We pay less in,
Yeah, go ahead.
yes, because differences in price, we pay less than we expected to pay.
Good. So in this case, at this volume, right, at this quantity of plastic, we had a favorable variance of 9,000. Now you see why this makes sense, what we did here? This is why we have the apples to apples comparison here. Because this would not allow us to have an apples to apples comparison. We can't, it wouldn't be appropriate for us to compare this with this. Why? Why is that misleading? Go ahead, Zeb.
We wouldn't know what was causing the $3,000 difference.
Right.
Whether it was quantity or price.
And
Isn't that what we did in A? That's exactly what we did. We took 178.1 and we subtracted 168.
right, so that's the total variance. But what we need to look at, remember I said we need to look and probe further to get the information that we need that's the most relevant to us. Because this is misleading. Isn't that misleading to look at that? Because how are we comparing the standard quantity the standard quantity at the standard price to the actual quantity at the actual price. Well, of course, how could they be the same? That's like with the sandwich example. Well, of course, you're using less bread. You produce less sandwiches. So how could these two numbers ever really reconcile if we had budgeted for 21,000 kilograms and actual was 22,500 kilograms? So what we need to do is to multiply the standard price times the actual quantity to find out if there really is a variance. To find out if there really is a price variance. So it's not that we're using less plastic. In this case, it turns out we're actually using more plastic. But see, that's what we're trying to find out. What's really happening? Are we using more plastic or less plastic? Or are we paying less for the plastic? Or are we paying more for the plastic? So this tells us, no, we actually, even if we use the standard price times the actual quantity, we see that there is a variance. So that means that the actual price per kilogram is less than what we had budgeted for. So it's less than 8 RM per kilogram. Isn't that what we said we were trying to find out? We're trying to find out if the variance is real. Not just we're using less bread. Well, of course, you're producing less sandwiches. So of course you're going to use less bread. But we need to look at the standard price at the actual quantity and compare that to the actual quantity at the actual price. And in this case, we found out that, yes, there is a variance. That means that, in this case, it's favorable, which means that Alex negotiated a good deal for us on the plastic. So we got a better price on the plastic. But as I had warned and cautioned you, there's a trade-off here. We paid less for the plastic, but we had to use more plastic. So we paid less, but we used it. The trade-off was, in this case, that we had to use a greater quantity of plastic. So you see why this comparison is more revealing, more appropriate, more accurate? To compare these two as opposed to this and this. This is still important to us because that's what we had budgeted. But we're not going to compare this to this because that would be misleading. But to determine if there's a quantity variance, then we should compare the 168,000 to the 180,000. Questions? So we have to see what's really going on at the company. All right, let's look at the third example, because I see some like blank stares. Don't worry, it'll still be over soon. Don't worry. Just hang in there. All good things must come to an end, so don't worry. But you won't be surprised when you see this on the exam, right? All right, so let's take another example. Let's look at the third one. Here we go. You ready?
What are we on, 9th grade?
Right. All right, so here we have an example of a direct labor variance. And Melissa has this business that prepares in-flight meals for major airlines. So that means basically Melissa's company services the airline industry. And one of the company's products is a grilled salmon in dill sauce with baby new potatoes and spring vegetables. So it's not exactly chuleta, but okay, we'll get by.
What are you trying to say?
Let's see. During the most recent week, the company prepared 4,000 of these meals using 960 direct labor hours. The company paid these direct labor workers a total of $9,600 for this work, which is $100 per hour. $10. See, I started thinking about those chuleta and everything, and then I just, you know. So, according to the standard course card for this meal, it should require 0.25 direct labor hours at a cost of $9.75 per hour. All right? That's not lira, we're talking about dollars. So what we need to figure out is what is the direct labor cost that should have been incurred to prepare the 4,000 meals? And how much does this differ from the actual direct labor cost? And then we're going to calculate the labor rate variance and the labor efficiency variance. So very similar to what we've done already. Just another example to find out if we're paying less or we're more efficient. So in this case, did we use less hours than what we had budgeted for? Or in the prior example, we were actually less efficient. We used more plastic than what we had anticipated. So let's take a look and see what we come up with. All right, 4,000 meals. We can do it, yes we can. All right, 4,000 meals, right? Number of meals? 4,000. So this is the standard direct labor hour. Direct labor hours per meal, which is what? So what does that mean? What's 0.25? 15 minutes. Is that right? So it's a quarter of an hour, so 15 minutes. And then the total direct labor hours allowed is going to be the 4,000 times the 15 minutes. But in this case, it's going to be helpful to keep it as a decimal, which is going to be 1,000 hours. Standard course per hour is how much?
975.
So 975. And that means the total standard cost is 9,750 for 4,000 meals. How much did we actually incur? How much was the actual cost?
9,600.
Right, 9,600. Everybody see how Damon got that? So it tells us that 960 labor hours were used to make 4,000 meals at $10 per hour, and it says that the company paid $9,600 for this work. So that's the actual cost incurred. So here we could see just our initial analysis, right? give us a foreshadowing of what's going to happen here. The standard cost per hour is $9.75, but we just said we paid $10 per hour. But we also used less hours than what we had anticipated. We used 960 hours instead of 1,000 hours. All right, so let's see where that leaves us. So the standard cost is $9,750. And that gives us the total direct labor variance of how much? 150. And is it favorable or unfavorable?
Favorable.
You see why? We had budgeted, our standard cost was $97.50 for 4,000 meals. But actual, for direct labor, we paid $9,600. So we have a favorable direct labor variance. But now we want to look and determine whether or not that's because of the fact that we used less hours or because we paid less per hour. And in this case, it turns out to be both. We used less hours and we also paid more per hour. So we have a variance, a rate variance, which is how much we paid per hour, and an efficiency variance, which is the number of hours. We had budgeted for 1,000 hours, and actually, we only used 960 hours to prepare those meals. So let's see how this is going to play out. So we have the actual hours times the actual rate, actual hours times the standard rate, standard hours times the standard rate. All right, so who's going to take us through this? What's the actual hours? How many hours did it take us to produce 4,000 meals? Right, 960. 960 hours. And how much did we actually pay them per hour? $10. So that's $9,600. Actual hours here is 960. And the standard rate was what?
975.
975. So we actually paid them more per hour than we had originally budgeted for. That's going to be 9,360. What was the standard hours? Standard hours, what did they tell us? 1,000 hours to produce 4,000 meals. As it turns out, we were able to do it in 960 hours. And the standard rate was 975, but in this case, as it turns out, we ended up paying $10 per hour. 9,750. So we're going to have a rate variance and also an efficiency variance. So the rate variance is here. And in this case, the rate variance is 240. Is it favorable or unfavorable?
Unfavorable.
It's unfavorable. Why? Because,
Okay, $10 instead of $9.75.
right, we actually paid $10 per hour, but we only had budgeted for $9.75. So we're going to have a rate variance. For 4,000 meals, that turns out to be, with this quantity of hours, a $240 unfavorable variance, which again means we paid more than what we had budgeted for. But we have an efficiency variance too, because we thought it was going to take us 1,000 hours, but we actually were able to prepare the meals in 960 hours. So what's the efficiency variance? How much is that? 390. And that's favorable. Who can tell us why?
Because you use less hours to produce 4,000 meals than you had budgeted for.
Absolutely. So we had budgeted for 1,000 hours. Actual was 960. So our labor rate variance is 240. Our labor efficiency variance is 390. And so that gives us a total variance of how much? $150 favorable variance. So this is also interesting because we have variances in not only the quantity, but also the rate. So there's two things going on here at the same time. But what we need to do is figure out what is it that's going on. So ultimately, we're going to have a favorable variance of $150. So there were some trade-offs. We paid more per hour, but we got better quality workers. So we decided to trade up and hire Brooklyn College students and pay them $10 an hour instead of $9.75. And what happens when you hire Brooklyn College students? You get productivity. And what happens? Brooklyn College students stepped up to the plate and they were able to produce 4,000 meals in only 960 hours. You don't get that at other schools. But at Brooklyn College, that's what's up. Questions? Are we good? Are we great? No. See, you ask a silly question, Krista?
I said we're all right.
Right.
Great.
Alright, now for my next trip. I'm going to sing a song for you? No, not today? Should have Lolita sing a song for you. Oh, this is a really interesting example. Midnight yet? What time is it?
8:15.
Really late.
No, we're on daylight savings time now.
Is the test gonna be like the same as the last one?
Yes. That's good, right? Let's see.
Same questions.
Same questions, same answers.